Good morning and welcome to the Park Bridge Wealth Management Spring Webinar Series. This program is entitled Hot Topics in New York State and New York City Residency and Personal Income Taxes. As always, my name is Jonathan Shankman. I'm the President and Chief Investment Officer of Park Bridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning, and you can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, and Trust and Estates magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that on Apple, Spotify, or wherever you get your podcasts. Today, we're privileged to hear from Timothy Noonan from Hodgson Russ, based in Buffalo and New York City. Tim is a partner and a tax residency practice leader at his firm, where he focuses his practice in the state and local tax area. His work primarily involves New York State and New York City tax litigation and controversy. Over the past 23 years, he's handled more than 2,000 personal income tax, sales tax, corporate tax, or other New York tax audits. Tim also has handled about 100 cases in New York's Division of Tax Appeals. He's handled some of the most high-profile residency cases in New York over the past decade, including the 2014 win in the Guyette case, one of the first New York residency cases to ever reach New York's highest court. He's often quoted by media outlets, including the Wall Street Journal, New York Times, and Forbes, on residency and other state tax issues. As the Noonan in Noonan's Notes, a monthly column and tax notes state, Tim is a nationally recognized author and speaker on state tax issues. And today, Tim will be speaking on hot topics in New York State and New York City residency and personal income taxes. And with that introduction, I'll now turn the program over to Tim.
All right. Thanks, Jonathan. Appreciate that intro. I also just subscribed to your podcast, so I'm on there.
You're welcome to come back anytime. I love it.
All right, sounds good. Well, there's actually also one of the guys in my office has it's called State Tax Talks podcast, where he talks to attorneys in our state and local tax practice group and others about tax topics. So I think Jonathan and I are podcast nerds. So there you go. So really, thanks for having me back. I've been doing this with Jonathan for 10 years, maybe longer. I used to be in person. With coffee and bagels and such. We've been doing it this way for the past 4 or 5 years, obviously. But it's a great group, so I'm definitely glad to be here. Great topic today. In a bit of nostalgia, I looked back at the PowerPoint from May 2020 when Jonathan had me do this right after sort of COVID came upon us, and it was sort of funny because I think I accurately predicted some of the major issues that would come out of my practice area, which again is state and local taxes with a focus on income taxes for high net worth folks. These residency issues are a huge part of my practice. And I just sort of thought at that time, granted, we were like 6 weeks into the pandemic, like, geez, I think there's some going to be some big issues. I was getting tons of calls at the time from people who wanted to leave New York and maybe Connecticut and some other places, California, things like that. And it was also people working from home all the time, which obviously a lot of people still do. And I thought, man, that's going to create some tax issues too, in terms of which state you have to pay taxes to. So we actually looked at that PowerPoint. We talked a lot about those things. It was funny because I had a couple of slides on, how to count days when you can't leave your state because of one reason or another, or you can't, states weren't letting people, from New York enter Rhode Island or something. I thought, man, thankfully, no issues have really come up about that stuff, but sort of funny / scary / sad to think back 4 years ago. But in any case, a couple issues that we had flagged back 4 years ago were, again, one, this concept of residency, where people live, people were moving, how to effectuate a move, whether a move is going to be permanent or not. That those issues have really been prevalent in this residency area. And then, telecommuting, how you do state taxes when you have workers who are telecommuting, that's become a massive issue. We'll talk about that a little bit today, this morning as well. I know in this format, you're just listening. I'm just talking to you, so we don't have questions. My contact information is here at the front. It's in the back. Always willing to take a call or answer an email if folks have questions. So feel free to ask us questions if you have them. So first, a couple data points here that I think is interesting. Some stats we've seen on Bloomberg recently. So, this is sort of an obvious slide here in terms of just, I think, what people are realizing, that more people have moved since the pandemic. You see, it's not doubled, but well, almost doubled in some cases, the amount of people leaving. Anecdotally, I've seen the same thing in my practice just with the amount of phone calls I get. I mean, I sometimes think I should change my voicemail to, "Hey, it's Tim Noonan. Sorry, I missed your call. Press 1 if you want to move to Florida. Press 2 if you want to move to Texas." You know what I mean? It's just, it's a lot. So I've seen that kind of volume. And the other thing we're seeing is it's not just people are moving, but, high net worth rich people are moving. Like this slide is really interesting just to see like the percentage of people who moved and their income levels before the pandemic and after. Again, kind of what we're seeing here too, which is, and I think or hope maybe states are realizing this as well, that the wealthy, it's easier for them to move these days, particularly with the ability to work from anywhere. So it's easier for people to move, and particularly for wealthy people to move. It's impacting these states like California and New York. In fact, New York, the governor's budget just passed, and there was a push by some legislators to increase New York's tax rate again. They already increased it in 2021, right in the middle of COVID, to give the combined New York state and city tax rate the highest in the country. I mean, it was crazy if they thought they were going to do it again. They didn't. And again, I think that's because there at least is some realization, even in New York, that you just can't keep raising taxes because we're chasing people out. But New York is good at, chasing people who are leaving. So if people leave, there's going to be an audit. Now, the data here is all New York audits. So it's corporate tax audits, sales tax audits, fuel tax audits, whatever. So there's hundreds of thousands of New York audits, and they collect billions of dollars in these audits. On the residency side of the house, personal income taxes, the number of audits, like real detailed field audits where someone moves to Florida and they file as, part-year resident or whatever, and they get audited. That number is probably, based on some data we got a few years ago, probably more like 5,000. That's a lot of audit activity, right? That's a lot of the tax department auditing lots of people who have moved. There's also a much greater number, and those of you who are accountants definitely saw this in 21 and 22, where the state did what we in our world we call desk audits. So they didn't send out an auditor to ask tons of questions and look at the residency issue in detail, for instance, but the computer kind of spit out a quick, "Hey, we saw that your allocation went down from 100% to 60%. What gives?" Or even, "We saw that you claimed a part-year resident status. What gives?" So really quick hitters, and we call them desk audits because there's not necessarily it's not a field audit. It's a more surface level audit. But we saw, I think that the number on those are a couple 100,000 in 21 and 22. We haven't seen that, and the tax department was very deliberate and frankly pretty smart, that they did that because so many people either telecommuting or moving, they didn't have enough auditors to chase everybody. So they set up this desk audit program to, again, maybe either quickly triage for bigger audits, or just to again, get kind of low-hanging fruit, and maybe low-hanging fruit for audit cases that normally they wouldn't take because the dollars are too small. So again, lots of activity in New York. Just as an interesting comparison, California, and we've seen, and lots of people reach out to us too about other state tax issues, and we have expertise, and we've handled issues in other states as well. California has come up a lot. A couple of folks on my team are licensed in California because we were getting a lot of California questions and activity. But interestingly, from an audit perspective, you see that the sort of volume of their audits is significantly less than New York. It might be 10% of what New York is. Now, it's funny, my experience with California residency audits are I sort of used to think New York audits were bad. I mean, these things go on forever. And because there's fewer audits, I guess there's like less of a track record, there's less precedent, and not just precedent like court cases, but just a system in place to sort of resolve disputes. You're dealing with the same people all the time, so you see a lot of the same problems, and it allows you to just more efficiently resolve cases, which I think happens in New York a lot, not so much in California. So, but what we see here is lots of people moving. That creates the kind of tax issues I thought would be huge 3-4 years ago. So let's talk about residency just real broadly. So I get a call, hey, Tim, I want to move to Florida. I don't want to be in New York anymore. So we're always want to have in mind the two residency tests, right? So the first residency test, called statutory residency, is sort of the objective test. It's also the one that most people are aware of, and unfortunately, it's people think it's the only test. It's called statutory residency, black and white. You can't be in New York for more than 183 days. And you can't maintain a permanent place of abode. Or stated another way, you're a statutory resident of New York if you maintain living quarters for more than 10 months of the year. It's called a permanent place of abode under the law. And you spend more than 183 days. Black and white, if you're under 183 days, you're not a statutory resident under this mechanical test. It's very important, particularly for my Florida movers, to not get overly focused on this test. Because if you spend 182 days in New York, good for you, you're not a statutory resident, but that probably means you're spending more days in New York than Florida. As we're going to talk about in a second, that's not good. But again, this mechanical test is always something we want to have in mind. And frankly, this is the kind of test that arises a lot for people who live in Connecticut or Jersey or somewhere, in the area, and they commute into New York for work. Well, if that happens and they have some living quarters in New York, even a small apartment that they don't use that much, they can actually be a resident of New York as well, New York State and city, and be a dual resident of 2 states. So this statutory residency test pops up a lot in the context of the commuter who's coming in and out of New York for work on a regular basis. Couple, things on this test. Day counting becomes really important. Being able to prove where you were, and actually being able to prove where you weren't. The burden of proof is on the taxpayer. The taxpayer has to prove that they weren't in New York for more than 183 days. So if you have a taxpayer who just uses cash all the time, there are a couple of those people still on the planet. It's hard to win a day count case because there's no proof of where you were. Thankfully, these days, 2024, everyone knows, the government knows where you are, right? I mean, we're carrying around cell phones, they're pinging cell towers, there's apps you can stick on your phone. The Moneo app is a great one. And but day counting becomes super important in this context for that test. It's also important for the second test, which is the domicile test. So we had our objective test, 183 days, but the domicile test, again, particularly for someone who's thinking about the New York to Florida or California to Texas thing or whatever, domicile is the other test. Under that test, your domicile is your state of residence for personal income tax purposes. Domicile means your permanent home, your primary home, and you can only have one. So you can't, so while you can be a resident of 2 states, you can only have one domicile. Importantly, as I stated a minute or so ago, this isn't the 183-day test. It's not, 6 months in a day outside New York and a driver's license in Florida, and I'm home free. It's not the way it works. Because it's a subjective test, we're trying to determine where your home is. So we're weighing a mosaic of facts and factors and circumstances, and we're seeing how much sort of favors Florida versus how much favors New York. And there's all sorts of factors. You can Google them, there's checklists on the internet. But the problem with sort of the typical checklist analysis when someone's doing this kind of thing is people aren't weighting which ones are important and which ones aren't, right? What is not important? Really, where your driver's license is, where your voter registration is, where your cemetery plots are, goofy things like, where your addresses are on your credit card. Like, these are all things that you sort of mind when you're doing a move, right? We're going to work through, we're going to change, we're going to do it, right? I'm not saying don't change your driver's license, but it doesn't advance your ball forward all that much. It's just not that critical to proving that your home has changed from New York to Florida. What is important is your time patterns. How much time are you spending in New York versus Florida? As soon as we end this webinar, I'm running over to a conciliation conference, which is like an appeals unit in New York. And this taxpayer did a lot of good things towards Florida. He retired. He got a home down there, or he had a home and he renovated it. He really did change his life. But he came back. He didn't travel back and forth a lot, but he came back for the summer. And summer sometimes started in the middle of May and went to the end of September. And he's got 150 days in New York. And New York says too many days. That's too many days. He spent 190 or 200 days in Florida, but he spent 150, 160 days in New York. And New York says that's too many days. And why are they saying that? Because the burden of proof is on us to prove a change of domicile from New York to Florida. And as it says on the slide here, it's got to be clear and convincing evidence. So look, I'm all geared up for this case. I'm going in a couple minutes. I think we have clear and convincing evidence. I think under the case law, it's just dandy and fine. If someone spends 150 days in New York, they can still be domiciled in Florida. But it's harder when your time patterns are like that, right? If your time patterns are like 2 to 1, I spent 210 days in Florida and 105 days in New York, and I did some traveling. That's better, right? In my experience, handling thousands of these audits, we're gonna win that audit most likely. And I'm not gonna have to go to an appeals bureau and fight it out. So time patterns become really important. Your housing becomes important. Did you downsize your house in New York? Did you upsize a place or buy a new place in Florida or wherever you're moving? So that's important. Where your business ties are also important. And with telecommuting, the tax department for years has said, if you're working remotely for a New York business, that's a New York business tie for purposes of the domicile test. So they'll hold that against you too. And of course, family is an important part of this too. Husbands and wives usually move together. So where your spouse is domiciled, that's going to be a factor. Where your kids are too, particularly young kids. You got kids in school and they're in school in New York, it's going to be tough to win. They're in school in Florida, it's going to be tough to lose. So, that becomes important too. So the important part of this domicile test, it is a facts and circumstances type thing. And the burden is on us to prove a move. The clear and convincing test is real. The cases say a close call, we lose. Tie favors the government. Anything close to a tie favors the government. It's got to be clear and convincing. So you got to build up those factors as much as you can. The other thing about the domicile move is it's got to be permanent or at least indefinite. We sometimes talk about this as leaving and landing. You have to leave New York. You have to land in the new place. And again, landing, obviously you get a place there, you spend time there, but it's also that you're there on, again, at least an indefinite basis. So what's happened in a lot of our cases, particularly around COVID now, is this sort of leave and land idea, right? So this is a fact pattern. I'm seeing it a lot now because New York City is auditing so many taxpayers right now for this issue. We have a New York City person with a place in the Hamptons or Connecticut or Vermont or insert wherever, but it was a vacation property. Went there during COVID, kept the New York City place, and ended up back in New York City in the fall of 2022. New York City is saying, okay, well, you're not a statutory resident. Good for you. You're under 183 days. But was that a permanent move to the Hamptons or to Connecticut or wherever? Did you leave and land? Or were you just a COVID refugee? You needed to get out of town for a while during COVID. If it's the latter, we're going to lose that audit. And for people who have come back and in 2022 filed a part-year resident of New York City and claimed to move back, that the auditors are now seeing because the tax return has been filed, the auditors are like, hindsight's 2020. You're only gone for a couple of years. That's not a permanent move. You didn't leave and land, right? You didn't leave, you didn't land. That's a problem. Now, we've had a number of these cases, and some of them are better than others. In some cases, I have people who really did COVID hit. They're like, I'm getting the hell out of here. I'm not coming back. And they gave up their apartment and they moved to a new place. Maybe it was a vacation place. Maybe they bought a new place. They had kids. They stuck them in school. And then after 18 months or so, or 2 years, they're like, it's not working out. And cities kind of come back a bit. I didn't think this was going to happen, but I'm going to move back. okay, like, and by the way, you can win that case, right? Life happens, circumstances change. If I could prove that my intention in the spring of 2020 was to permanently leave New York and permanently land in the Hamptons and stay there for good, or Florida and stay there for good, I should win, right? The fact that things happened later that changed my intentions doesn't mean that my intentions were good and valid and honest in the spring of 2020. It's just, on paper, a case like this doesn't look good. It's not, it doesn't mean it's fatal, doesn't mean you're going to lose, but this is a fact pattern we're seeing a lot. I mean, again, it's in 2 years, 3 years when I'm doing this with Jonathan, like, this probably won't be an issue anymore. Maybe there'll be a couple of court cases that are still lingering, but this type of issue, it's so unique, and specific to what happened in COVID. But in any case, those are some of the issues that are coming up. So the other thing going on, as I mentioned before, is that New York is very active in auditing people. Thousands of audits every year. Over 25 years of my career, I've handled thousands of audits. There's just a lot. There's a lot of activity. They have a sophisticated audit program. They're aggressive, and they got AI going or something. Like, when people move, they file as a part-year resident. If the income is at a certain level, it's going to be an audit. Like, it's not, when people come to me for help in planning a move, we're not doing things to avoid an audit, right? That's just not possible. In fact, sometimes we're just happy, we're glad to get an audit because we'd like to get it over with. We know it's coming, let's get it over with. What's interesting is, New York has had over the years, again, a huge staff assigned to handle these types of cases. That number is dropping. The IRS is picking off lots of New York tax auditors, like a lot. And it's the kind of thing that I think what we'll see, both with the number of people moving, as we saw from those slides earlier, and maybe the decrease in staff at the tax department. Look, the audits aren't going to go away. I mean, I got a bunch of kids to put through college. I hope they don't go away. But I think the sort of the threshold, right? Whereas maybe 5 years ago, I said, hey, if you're making $500,000 to $1 million and you move, expect an audit, that threshold's probably up. Maybe it's double that now, right? Maybe it's $1 million to $2 million, you or your clients. That could be the threshold. So the likelihood of audit really depends on the amount of income, right? That New York's, smart in that regard. They're not chasing after everybody. It's funny, they did, as I said, during sort of post immediate COVID years, they did that desk audit program where the threshold was a lot lower. But in a typical field audit, where the auditors are sending long information requests and there's a lot of back and forth, the dollar amount, again, it's at least in the seven figures these days. And a couple things to keep in mind in terms of these audits and really planning for these audits. As I said before, the burden of proof is a real thing. Close calls are not where we try to angle people. I certainly get a lot of cases that, I didn't do the help on the planning where there is a close call, and we'll fight those cases. But if you're on the front end and you're planning a move, you try to do it so there's not a close call. The other thing you're trying to do on the front end is, as I said before, day count proof, like prove where you were, where you weren't. Cell phone data these days is, again, a blessing and a curse, mostly a blessing. We know where people are, and we don't, 20 years ago, I don't know, maybe 10, 15 years ago, man, I would be spending days going through Easy Pass and credit cards, and it was a nightmare. Not so anymore. It's a lot easier to do day counting these days. So all that's important. Again, we're still doing field audits these days. The difference is, I was telling Jonathan this morning, most of the audits I used to do, we'd, the information request would go out. We'd talk to the auditor, set a couple days to sit down in our New York City office, get a big stack of paper, a couple bankers boxes, go sit with them, chat for a bit, leave them the information, and then they'd be there for a couple days, and I'd be there for a couple days too. And we'd go back in and out and have, some back and forth. That doesn't happen anymore. We get an information request, we put together a huge submission, we submit it electronically, and then we wait. And then there's a call or there's a WebEx or whatever, but they're just different. The way the audits happen are just a lot different. The in-person aspect of it is pretty much gone. The other thing is, this has always been the case, it's not a zero-sum game. In other words, it's not like if they disagree, you lose and you pay 100%. And if they agree, you win and you pay zero. Sometimes, and oftentimes, there's a settlement. if it is a close call, or if there are some good facts and some bad facts, there's lots of opportunity to negotiate. And oftentimes, and really, I try to have it be in all cases, if we're going to negotiate, if we're going to pay anything, we want to pay something with a recognition by the tax department that at some point the taxpayer established residency in another state outside New York, right? Because you don't want to have to deal with this year over year over year. If you're going to cut them a check, make sure it's worth it, right? Make sure to get what we call a domicile determination. All right, so real quickly, that's sort of the residency side of the house. Even if someone moves, you still have to be mindful of non-resident taxation, or what we call non-resident allocation. So income that is sourced in New York, even as a non-resident, you still have to pay tax on. And the biggest thing I'll sort of address right here is telecommuting, right? So if I'm a wage earner, I'm getting salary plus bonus or stock-based compensation. The sourcing is determined based on my work days. The amount of days I work in New York, if it's 60%, I got to pay tax on 60% of my comp, right? That's easy. With the telecommuting, what the New York's telecommuting rule says is, well, if you're working from home for your own convenience, it's called the convenience rule, then that day gets treated as a New York day for purposes of doing that math. So remote work in New Jersey or in Connecticut or in Florida, New York says that's a New York day. There's some exceptions to that that are beyond the scope of what we're covering here today, but that's the rule. And in COVID, New York doubled down on that rule. So much so that there's a case, and actually a couple of cases we're handling, one that's percolating through the appeals process right now, where the taxpayer was working from home in 2020 and 2021 because their office in New York was closed. And the governor, because the governor closed the office, right? The employer closed the office. There was no place to go. New York is still saying, sorry, remote work, that's a convenience rule. Convenience? I was working from home for my own convenience. My office was closed. New York doesn't care. So that's frustrating. That case called the Zielinski case is the lead case that's working its way through the appeals process. Interestingly, you might have heard that New Jersey, who has always historically sort of taken it on the chin, right? Someone remote working in New Jersey who lives in New Jersey for their New York employer, they pay New York tax, and New Jersey would give the credit for the taxes paid to New York. So again, New Jersey wasn't getting anything really from that resident taxpayer. They haven't changed that. So New Jersey is still willing to give a credit for remote work days. What they have said is that they're going to do the opposite, right? If there's the opposite situation where someone's remote working in New York, for their New Jersey employer, New Jersey says, we're going to take that income now. They used to not do that. But the other interesting thing they said is that if you sue New York, New Jersey resident taxpayer, and you win, when you come back, because if you do that, you got to go back and you got to give it to New Jersey anyway, right? Because you took a credit for the taxes you paid to New York. If New York gives you your money back, you owe it to New Jersey. New Jersey has said, if you do that, you only have to pay back half of the tax. Pretty interesting, right? They're almost spurring on people to sue New York, to fight New York on the convenience rule. And again, if you do that, the kicker is New Jersey only requires you to pay back half of it. Or you get a credit for, you basically get a credit for half of the tax you paid to New York. So again, the dollar's got to work, right? There's a lot of machinations that have to happen for someone to fight New York, get a refund, go back to New Jersey. Like there's a lot, right? So the dollars have to be pretty big. We have some clients who are interested in it. It's pretty cool. Connecticut is thinking about doing the same thing. So keep that in mind. Again, my view is there already is this lead Zielinski case out there. If the taxpayer wins that case, again, where he's saying my office was closed, I couldn't go. And again, we have a similar case that's working its way through. Then I think the floodgates will open for people whose offices were closed, at least, to go ahead and get refunds. And in that case, they could take advantage of this New Jersey program. And then the only other thing I'd say with non-residents, always be mindful that non-residents, again, don't pay tax on non-sourced income. So interest income, capital gains income. In the hedge fund context, we see this with carried interest. Carried interest is not, just like it is federally, it's not ordinary income. It's not sourceable income for New York State purposes. So that's a quick half hour, guys. Thanks for joining. Again, all my contact information is here. So as I said at the outset, feel free to ping me with the call or email if you guys have questions. And thanks everybody for listening.
Great. Thank you so much, Tim. If anyone has any specific questions, new business opportunities, or any other issues I'd like to discuss, please feel free to reach out directly to Tim or myself where appropriate. And I'll be sure to include his contact information in the follow-up email of this program. As I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Three more quick items before I let you go. First, my spring webinar series continues on May 16th on the topic of unraveling the challenges in estate planning, navigating copyright law, and preserving creator content, featuring Mark Mistal and Michelle Yang, both of New York City-based law firm Offa Kerman. This program is for CP and CLE credit, and I'll send out an invitation to this program in the coming days. In the meantime, if you have a friend, colleague, or client who'd like to be notified of my upcoming webinars, they can email me with the word webinar in the subject line, and I'll add them to my webinar distribution list. My email is jonathan@parkbridgewealth.com. Second, you can follow all my work on Twitter and Instagram at Jonathan on Money. You could also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my new daily financial planning videos by following me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.